Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
Thank you for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from our Wilson Investment Properties headquarters in Silicon Valley. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. Go to TomWilsonProperties.com also to sign up for our newsletter on real estate and economic trends, and to also become a part of our client base so that you can get access to new commercial syndication deals that we offer, typically for $50,000 a share, which allows you to invest in products that are normally only available to high-end investors, institutions, and REITs. And we always welcome your questions and suggestions for topics and speakers. So today we're privileged to have Dr. Doug Duncan back on our program, the Senior Vice President and Chief Economist of Fannie Mae, who has a PhD in agriculture economics from Texas A&M. So he can legitimately say he's well-grounded. He's a former chief economist at the Mortgage Bankers. I'm sorry, I couldn't help it, Doug.
It's going to be one of those
former
days,
chief economist at the Mortgage Bankers Association, and he provides all the forecast analysis on the economy, housing, and mortgage markets for Fannie Mae. He's won multiple awards for the most accurate economic forecaster in the country, named one of Bloomberg Businessweek's 50 most powerful people in real estate. Doug, welcome back to the program.
Thank you. Thanks for having me back.
Doug, first of all, so we are, this broadcast is in June of 2018, and Dr. Duncan was wonderful enough to be out here last week and spoke to one of the largest audiences we've had for that there's been in the San Francisco Bay Area for a long time, which I think reflected not only his credentials, but people's interest in economy this day and age, trying to figure out what it means and how to make decisions based on that. During that event and during our lunch reception for you, Doug, you got a lot of compliments and stimulated a lot of discussion about our economy and housing. Indeed, do you have any takeaways from your discussions with kind of Main Street? Admittedly, the folks you talked to are pretty educated Main Street, but they were quite interested. What takeaways did you have?
Well, people recognize the public discussion of this being a long, though weak expansion, and are starting to think about when it might end. So questions about when do you think the next recession will happen. People concerned about affordability, not surprising given the economy in that area and house prices as a result of the strong growth and job growth in the area. So people worried about the affordability, and then on the flip side, whether or not the current levels of prices can hold, particularly if there were to come a recession, which eventually there will. So those were a couple of things. But a lot of people in the audience were also interested in the investment potential of real estate and how to think about where we are in the economic cycle as they're considering alternative investments, including real estate. So it was there was nothing that hugely surprised me, but there was, I would say, optimism in the long term, but some caution in the near term.
Okay. You've got, I think, somewhere close to 100 speaking engagements this year, as you have most years, not including even Capitol Hill. Why do you? It surprises people. Most people think that you'd be stuck in meetings on Capitol Hill all the time, which I'm sure you could be. But why? So tell our listeners why do you devote so much time away from Capitol Hill?
Yeah, I don't. It's funny you should cite the number. I actually asked my assistant this morning if she would go back and calculate for me the last 12 months and actually list out who I spoke to, because I'm thinking about the next 12 months to figure out how to allocate that amount of time. The reason I allocate time to it is because we can run models of economic activity in different sectors, the overall economy, housing. But by definition, a model is an abstraction from reality. In other words, it leaves out information because you can't include all information, and you may not know what's all the relevant information. That's one of the reasons we run models. But it's always very helpful to be able to benchmark model results against what people say they're doing, particularly decision makers. So I don't typically talk to just the man on the street interview about housing. I talk to people who own houses or people who invest in houses or apartments. I also talk to people who build them. I talk to people who finance them. And I talk to people who hire people, whether they're in real estate or not, because I just like to hear from them, their view, because they are invested and they make decisions on those things. And then if there's a disconnect between what I hear from them and what I see as we do our research and modeling, then I have to explain that. How do I explain that difference? And in some cases it might be that there is a particular type of business that, while most of the economy is doing okay, that type of business is having a problem. Well, that's one piece of information. Or maybe one region may be varying from some other regions in terms of activity because of the nature of output production in that area. Maybe take, for example, export-import. If you're in a heavily export-import market, then the trade negotiations might be chilling some activity, and so it would be reasonable that sector would differ from another sector. But really, it's to collect information on the ground to benchmark what we do when we sit in our offices. And that's turned out to be valuable in explaining, in particular in housing, why this recovery has been so weak relative to history. That's been very useful.
I can't imagine any listener not having a lot of respect for you collecting real data and meeting with people who are the ones that are seeing the real world out there and making things happen. I'm devoting part of this program to kind of no investor left behind, to quote the real estate guys, what they often do. So I've had a lot of questions from folks saying that was really interesting what I heard, but I don't understand some of the basics. So can you just very briefly at a high level, let's go through several points here to give folks a little better feel. So what is Fannie Mae? Everybody says, oh, Fannie Mae, what's a Fannie Mae loan? Well, what does that mean? What's Fannie Mae's responsibilities? And how much of our U.S. loan underwriting does Fannie Mae do?
Well, first of all, we're not a candy company. We get that from time to time. The best way to think of us is as an insurance company. So a customer, a person who wants to borrow money to buy a house would not come to Fannie Mae. They would come to a lender. They could be a bank or a credit union or an independent mortgage company, but they would go to them, and if they're successful in acquiring a mortgage to buy a house or to refinance their current house, then that lender would come to Fannie Mae if the loan met certain criteria and ask Fannie Mae to either purchase the loan from them, or if they combined that loan with a bunch of other loans and created a bond backed by the payments on those mortgages, ask us to guarantee the timely payment of principal and interest to the investor in that bond. So basically, the person that owns the house making their monthly payment, that cash goes into a payment to an investor who buys a bond backed by those individual mortgages. And we provide the guarantee for what's essentially an insurance premium to that investor. So that's really the only time we would come into contact with a borrower directly would be if they had a difficulty paying their mortgage. But even then, typically we have companies called loan servicers who collect the monthly payments and forward those, and they would be the first line to intervene to see how we could help that borrower become current. Fannie Mae is about 30% of the total market. If you combine us with Freddie Mac, who's a very similar company, and with Ginnie Mae, who is a government-owned company that does some similar things, the total of that is probably somewhere 80% of the market. It varies from time to time. It's been as low as 70%, as high as 90%. But the majority of it is insured or guaranteed by those three entities. Commercial banks and other investors may hold individual loans in their portfolio. That would be the remainder of the market.
Okay. What about FHA? Where does that fit in there?
FHA is a government-owned insurance program, and if you take out a mortgage from FHA, you will be paying a mortgage insurance premium, and that insurance premium is to pay the investor in that mortgage in the event that the borrower does not repay the mortgage. And they are a government-owned entity, and their loans, along with the guaranteed loans of the Veterans Administration, combined are the collateral behind the mortgage securities guaranteed by Ginnie Mae, which is a government-owned corporation.
Okay, good. That's very very helpful, I think, for our listeners. So we'll come back after the next segment and get into some more details of this whole process and how it plays out in the future. So we have Dr. Doug Duncan on today. It's the Senior Vice President and Chief Economist of Fannie Mae, talking to us about U.S. loans. So stay with us, and we'll here on Real Estate Radio Power Investing. We'll be back in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
We have Dr. Doug Duncan on back with us today, Senior Vice President and Chief Economist of Fannie Mae. Whom fortunately we had out here last week live in Silicon Valley, speaking to a large audience who's very interested in economics these days, and more than they used to. Talk to us, Doug, about FHFA. Who are they and what's their role?
FHFA is the Federal Housing Finance Agency. They are the regulator of Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system. So they have oversight in a similar way that the Federal Deposit Insurance Corporation, FDIC, has oversight over banks. FDIC is actually an insurance, provides deposit insurance. Another regulator that might have some similar characteristics would be the Office of the Comptroller of the Currency, who also has a regulatory oversight over commercial banks. FHFA is over Fannie Mae, Freddie Mac, and the Federal Home Loan Bank system. And today, given that Fannie Mae and Freddie Mac were taken into conservatorship at the end or in the middle of the crisis, the recent crisis, actually in September of 2008, they're in many ways an active participant in the management of the companies. The difference between conservatorship and receivership from a legal perspective in the regulatory world is conservatorship implies that the conservator is responsible for overseeing the maintenance and development of the assets for release back into the market, whereas receivership is intended that the institutions will be closed and the assets distributed to the claimants on those assets. So the idea is that at some point, Fannie Mae and Freddie Mac would be released out of conservatorship back into purely a perfectly private status. That requires some legislation to pass in order to execute that. And the Congress and the White House have not been able to agree on exactly how to do that. So we remain in conservatorship.
That's the first time that's been a problem, huh?
It is. There was a slightly similar circumstance in the Depression. There was an organization that was created to take the assets off, the mortgage assets off of bank balance sheets subsequent to the banking holiday. But that institution was designed and was wound down and extinguished as those assets were worked out. So that was more of a kind of a receivership mode, if you will, not exactly, but more aligned with that than conservatorship.
Who ultimately owns the loan that the banks initiate and that Fannie or Freddie or insure, so to speak? Who ultimately owns them?
Well, it would be if a bank makes a mortgage to you and they keep that mortgage, then they own it and they can hold it in their portfolio and you would make payments to the bank. If it is packaged with a bunch of other mortgages and then a bond is issued into the marketplace and sold to investors, and the payments on that bond come from the repayments of the mortgage, then ultimately it's the investor that has the claims on that mortgage. We're a guarantor in the middle of it. If it's a loan in a security which Fannie Mae provides the guarantee of time and the payment of principal and interest, then if the loan goes into foreclosure, then the proceeds from that are captured by Fannie Mae ultimately.
Mm-hmm. Okay. And all right. And the federal, a lot of the assets now have been being reduced and by Fannie that they're responsible for, and moving over to the Fed. And we're going to discuss that in a moment when we come back from for the next break. Mm-hmm. So that's a surprise, I think, to a lot of people that's shifted that much. We have Dr. Doug Duncan with us today, Senior VP and Chief Economist of Fannie Mae, talking about U.S. loans, the loan process, what the future is, and what direction things are going. So stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Dr. Doug Duncan, Chief Economist, Fannie Mae, back with us today. So, Doug, talk about the transition here to Federal Reserve, which Federal Reserve's role in U.S. housing and loans, and how that transition is going.
Well, in the course of the recent Great Recession, in order to attempt to put a floor under house prices, which were falling precipitously, and also to allow homeowners, also to lower interest rates, to allow homeowners to refinance their mortgages and lower their payments and improve their cash flow position. The Federal Reserve, for the first time, purchased assets other than U.S. Treasury bills and notes, and they purchased mortgage-backed securities. And in fact, they purchased them ultimately holding about $1.8 trillion of mortgage-backed securities. And as I said, they've never held mortgage-backed securities in the past. So they became the world's single largest holder of mortgage-backed securities. That was at the same time as, under conservatorship, the law that was imposed on the Fannie Mae and Freddie Mac, called the government-sponsored enterprises, the law that was put in place mandated that Fannie and Freddie would reduce their investment portfolios dramatically, and that down to about $600 billion. I forget the exact number, but dramatically smaller, and that means that they will not be growing from that level going forward. So the implication is, now that the Federal Reserve has said that they were going to, and has actually started to reduce their holdings of mortgage-backed securities, the implication is that someone else, as a set of investors, will have to acquire those mortgage-backed securities going forward. So that will, over time, then we will see how that impacts interest rates for mortgages. But the expectation is that if everything else remains the same, interest rates for mortgages will rise somewhat. No one knows for sure. Our best estimate is somewhere 25 to 40 basis points, a quarter, maybe to a half a percentage point as a result of that change, but it could be more or less. It's never been tried before, so no one's actually sure.
So one of the reasons for Federal Reserve holding these assets is that to give them another tool, along with interest rates, to help regulate the economy, and if they feel like they need to.
Yeah, that was the intent. Was to stop the recession, which was heavily related to the downturn in housing, not exclusively. People forget that oil exceeded I think $120 a barrel before just as the crisis started. So on balance, their intent was, in the purchase of both Treasury securities and mortgage-backed securities, expanding their balance sheet would put a floor under the decline in economic activity and support the return to growth. That was their objective.
Okay. All right, we need to take a break. We'll be back in just a moment with Dr. Doug Duncan, Chief Economist of Fannie Mae.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Dr. Doug Duncan with us today, Chief Economist, Fannie Mae. Doug, what has been done since the crash to reduce the risk of a repeat in the, at least in the housing sector and loan defaults?
Well, there was, as you know, there was a new regulatory agency created, the Consumer Financial Protection Bureau, which was intended to increase or institute regulations protecting consumers from from some of the things that occurred during the crisis. In terms of lenders, and there was some legislation that mandated certain criteria about how mortgages would be underwritten. The thing that you typically hear is about debt-to-income ratios. That they've classified mortgages into qualified mortgages, which means they meet certain criteria which require a lower level of regulation and liability to the lenders. And that includes loans that qualify for Fannie Mae or Freddie Mac guarantees. Those would be included in the qualified mortgage category. In terms of the way that we at Fannie Mae think about them, we underwrite these mortgages as well to determine whether or not they meet our criteria for risk and return. I guess the easiest way to describe what we have changed is to remove layered risk. And what I mean by layered risk is if a potential borrower has an erratic employment record and they have a low credit score, which is evidence of their spottiness of repaying loans, and they're not putting much money down, those would be considered three potential risks all layered into a single loan. Today, it would be very difficult to get a loan with those three risks. Now, you could have a spotty employment record if you were paying a lot of money down, and if you had a good record of repaying your debts, irrespective of that spotty credit record, that might be acceptable. Or if you weren't as regular in paying your credits, but you were paying a lot of money down and you had a very good employment record, that might work, but not all three. So the underwriting, and I'm just giving that as an example, there are many elements to that, but I would say that's the biggest thing that's been done on the underwriting the risks in mortgages is trying to weed out layered risks.
Has there been a factor included, like when you've had invited me and Bruce Norris back to speak to Fannie Mae, and we've talked about loans that for which the rent could be cover the mortgage. Has that been part of the discussion?
Well, one of the attributes of that, which you may have seen recently that we released information on, is doing some work with Airbnb, where if a household has a home and a mortgage and they have a consistent, sustained record of earning income by renting out rooms in that house through Airbnb, that we would consider that in the underwriting of a refinance loan on that property. So that's a variant on what you've suggested. In addition, we have what we call Home Ready, which is a mortgage product that recognizes that in some households it's typical to have multi-generational folks living in the home, even though only a subset of them are actually on the mortgage. But if there is, again, a sustained pattern of financial contribution by other residents in the home not on the mortgage, that would also be considered. That comes under a product called Home Ready. So yes, we're trying to understand those characteristics of households which give a more complete picture of their financial capacity and their ability to manage credit. And if you think about what lenders and Fannie Mae and Freddie Mac think about, it used to be called the 4 C's. Think about credit. Have you managed your credit well in the past? Collateral. What's the value of the home? Because if the mortgage is not repaid, that would be have to be taken in repayment for the mortgage, what's the capacity, in other words, what's the overall financial strength of the household, and what's used to be called character, which is just, do you give evidence of even under stress attempting to meet your obligations? So it's really reflected in those things that we're attempting to understand the differences between households and how different things might reflect their ability to manage credit well.
We just have a minute left in this segment. We're the only country, I think, with 30-year low-interest loans. Do you think this is essential to our economy, and are these loans sustainable?
Well, I think actually Denmark has long-term fixed-rate mortgages as well, but the mechanism is a little bit different. The surveys of consumers suggest that all of them want access to a 30-year fixed-rate mortgage if they should want it, but they also want some choice. So they would like to be able to choose among adjustable and fixed-rate products. It's highly unlikely that you will ever see the extinguishment of the 30-year fixed-rate mortgage. And in fact, households who would have taken adjustable rate mortgages over the last 30 years would have done very well because of the long-term steady downward trend in interest rates. That's probably going to change a little bit going forward, but I think consumers still are going to want the option.
Okay, we need to take a break here, and then we'll come back and ask Doug, what's the future of the economy here? So stay with us here on Real Estate Radio Power Investing. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Great pleasure having our good friend and Dr. Doug Duncan, Senior VP and Chief Economist, Fannie Mae, back on the program today. Doug, I'm going to ask you for a little prediction here in a second. Cryptocurrency, that's something everybody's talking about. What is that? How's that going to play out? Just very, very briefly.
Time will tell. Governments are starting to take a view, and I think that's a part that we don't know exactly how they will take that view. I think it will be with us for a while. Whether it reaches the original vision, uncertain.
Okay. Probably some regulation in the future.
Yeah, I believe there will be. Governments are loath to give that up.
Where would interest rates be today if we did not have any government intervention?
Well, the base interest rate on which mortgages are priced, of course, is the U.S. 10-year Treasury. So it's really, the question is, what's the spreads over that? If the market were purely private, the spreads would be wider than they are today. How much wider is a point of significant debate, and that would actually change depending on where you are in the economic cycle. In a stress cycle, they would be significantly wider. In an expansionary mode, it might be much tighter, but definitely wider, unbalanced than today.
All right. Interest rates, Fed hikes this year? What's left?
Oh, well, it's interesting. We were taking some criticism up to a couple of weeks ago because we only have 2 more increases in our forecast, but in the last week, the market has come back to our view from the market had moved to where they thought there would be 3 this year. It's come back to our view now with, and so we're holding fast 2 more increases this year in our view.
Right. Probably one in June, one in December.
That's what we're thinking. We think they may take a pause in the fall just to see when the runoff from their portfolio starts to bite. How does that impact? Rates? We view that as tightening, and it's unclear exactly how much tightening the market perceives that to be.
Okay, and the next recession? You're predicting what next year, third or fourth quarter?
Well, we don't actually have a recession in our forecast. We have a slowing in the second half of next year, which I believe will occur, and a slower 2020. What that suggests is that, well, about that time, this will be the longest expansion ever, and if the Fed is tightening into that, that's a risk, an accelerated risk of recession. Then.
So predicting a peak out in the second half next year. Doug, thank you for being with us. Dr. Doug Duncan, Senior VP and Chief Economist, Fannie Mae. Nice to have him back with us again here on Real Estate Radio Power Investing. Go to TomWilsonProperties.com and sign up for our weekly newsletter on the economy and real estate, and also give you access to commercial syndications that Wilson Investment Properties offers to our client base at usually $50,000 a share for investments that normally only large investors and institutions can be involved in. So thank you again for all of our listeners for being with us. Thank you, Doug, for being with us again. We look forward to having you back here on Real Estate Radio Power Investing. And remember, the only thing that matters is what you do next.